Hey everyone, it's Monday, October 17th. Happy raging bull market. We're back pushing to the upside, although not a lot of further upside movement through the course of the day. We'll look at the S&P, the Nasdaq, and a lot of other asset classes as well. Ladies and gentlemen, this is the final bar. Hey everyone, welcome to the final bar. I'm your host, Dave Keller. I'm the chief market strategist here at StockCharts.com in a smoky Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets. Using the power of technical analysis, the technical toolkit is really optimized to help you make sense of markets in uncertain times. It focuses on trend and momentum and breadth and sentiment and key price levels, all of which I would argue are incredibly valuable when you're trying to make sense of things when things get crazy, when things get volatile. We'll look at a bunch of charts here in the next 29 minutes or so. Did want to let you know about the schedule coming up this week. We had a couple really good guests last week. Katie Stockton's conversation stands out to me as a really interesting one in particular. This week on Tuesday, we have Dana Lyons, editor of the Lyons Share Report, portfolio manager at J. Lyons Fund Management. On Wednesday, the 19th, author Hema Reddy is an expert in GAN analysis. Have not had a GAN analyst, I don't think, on the show, maybe ever. But I'll be really interested to hear Hema's take on this current market environment. Jeff Huge from JWH Investments will be with us on Thursday from Minnesota. Jeff is a fantastic stock picker. Really interesting the way he lays out the environment. We interesting his take as the S&P potentially testing a new low here. Also wanted to let you know I have a webinar coming up tomorrow. Go to marketmisbehavior.com/October and you will get the info on this upcoming webcast. It's called the Market Bottom Checklist Revisited. Back in June, we did a webcast where we talked about 10 items we were watching going into the June low. We're going to update that for where we're at today, talk about some of the guideposts that I would be looking for to make sense and start to proclaim a market bottom. Also, the seasonal tendencies in November and December. You can sign up for that free event at marketmisbehavior.com/October, and I hope to see you there. Let's continue on our show today with the market recap. As I mentioned, I've sort of announced the show, happy bull market or happy bear market. I feel like one day, all of a sudden, there's a huge change. We had that last week on Thursday with the big upswing, Friday with the big retracement back down, cutting about halfway through the gains, if not more, on a lot of names. Today, right back to the upside. Now, there's a lot of news flow bouncing around, a lot of earnings certainly this week with names like Tesla and Netflix coming out through the course of this week, a bunch of financials earlier today and also over the next couple days. So a lot of charts to go through. We'll start with the big picture and just sort of what happened today. So, nice rally overall. Again, a lot of that was the gap out of the open. After that, I would say not a big, movement to the upside, not a lot of follow through. And that's noteworthy, right? The S&P sort of gapped higher, traded up to just below 3690. That was the high watermark for the day. So it's not like, Friday, which was like this slow and steady decline, and we finished at the lows. Today was like the gap, kind of a reset from Friday, but then it was more of a sideways day, right? It's like once that move was digested, no additional buyers really coming in and pushing prices dramatically higher. So the S&P closing just below 3680. That's still up 2.7% from Friday. The Nasdaq composite even better, up about 3.5% from Friday's close. The VIX chopped around quite a bit. It's down a bit from where we were on Friday, around 3130. So still fairly elevated, but coming off from some of the higher levels we've seen recently. Interest rates, we see the 10-year yield dipping well below 4%, but closing back above there. That was actually an interesting read today. We saw the bond prices gap higher at the open, but through the course of the day, bonds came off and rates just chipped higher and higher to go just above 4% on the 10-year yield is around 402, about the same as the long bond yield, to be honest with you. Of course, 5-year yield is well above there, 424, which is what's causing that inverted yield curve you've heard so much about. Interesting today, by the way, to see stocks rally while the dollar was coming off. That's the opposite of what we've seen. If you remember the show from Friday, we looked at the 5-day returns, our wrap the week chart. where you had the dollar up and everything else down. This was a bit different, right? You had sort of a mixed bag of things going higher while the dollar came off a bit. A lot of red on the chart of commodities. Gold had a really weird chart today. If you look, a gap higher on the GLD, but then all of a sudden it looked a lot like Friday session, just sort of dribbling lower through the course of the day. Same thing happened today. So technically finished in the green, but I would say the feeling I got watching gold go down the whole day was not a soft and fluffy, everything's fine feeling. That was more of a, maybe that gap higher was a bit of an overshot. And now we're kind of coming back to where the market thinks that should be. So overall, a lot of deterioration through the course of the day for commodity prices. Energy, one of the worst performing sectors in the S&P. We'll get to that in a minute. You're seeing a bit of a rotation here just on the last 24 hours on Bitcoin and Ether, but let's keep that into proper context. Bitcoin's still below 20,000, and until it does that, at the very least, I think it's hard to get too excited about Bitcoin prices going forward, right? It's sort of you need to eclipse a key level of resistance before you can continue on and go further. Not there yet. Ether above 1,300, which is interesting, just above 1,325, and most of the top 10 coins we track in the positive today, not by much, but noteworthy that they were certainly up there. Let's look at a chart of the S&P 500. Boy, it has been a crazy week or so among crazy weeks. I feel like the last month has been a fascinatingly challenging period. So could we have scripted a better time to try and pull off a virtual conference like ChartCon? Probably not. That was a lot of fun talking with all of my fellow contributors. That was this Friday, was when we go live with ChartCon, the gap lower, and then we're trading lower through the course of the day. Poor Joe Rabel's trying to do a recap of the technology sector as like they're all on fire, kind of driving to the downside as we're going live. But they handled it well, I thought. And again, as we talked about before we got started, this is a real life situation. This is great for our viewers to see how you guys are navigating these markets. And I thought they delivered really well along those lines. Now, the last couple of days, pretty crazy. I'm going to zoom in a little bit just so we can take a view at the candle chart at the short-term environment. So, here was the low point in September. We got right to 3,600, a little bit below there, and then bounced. That was that gap higher 2 weeks ago. That was the week of ChartCon. We then gapped lower on Friday. This was Monday, Tuesday, Wednesday, making a new closing low for the year. And then this really strange candle on Thursday of last week, a bullish engulfing pattern for the S&P and the Nasdaq, for a lot of individual names as well, and very much a bullish outside day. Friday sort of unwound all that optimism from my read, right? So you sort of gapped higher, but then closed at least 50% of the way down. That's actually a bearish candle pattern. It's a reversal pattern. Then today, we open up in the middle of that range and then trade a little bit higher. So it's a bit of a narrowing of the range, right? Volatility kind of coming in overall. However, it's certainly chopping around. And I would tell you that when I'm looking at this pattern over the weekend, I was writing a note for my premium members at Market Misbehavior. One of the things we talked about is when you have a weird sort of 2-day pattern, you're trying to wonder, what to do next because you're getting conflicting signals. Look at the extremes of that pattern. So one of these two things is going to happen. We either blow above 3,700 or we blow below 3,500. One of those things is going to happen theoretically at some point, maybe as early as tomorrow, maybe through the remainder of this week. By the way, a lot of earnings this week and triple witching day on Friday. If I remember right. Yeah, it is. So, what that means is, sort of sit tight if you have the ability to do so and see which way this market breaks. If we go above 3,700, that opens the way to 3,800. These are short-term levels, but important to watch. We blow 3,500 though. What's left? And the answer is not much. And the challenge I would have for this market, and we'll get to some of these when we get to shifting stocks after the break. Charts like Tesla, it's like once you break support, where are you looking next? Microsoft, right? Going to a new low. There's no real support there below, much further to the downside. I think that's a challenge for this market right about now. Our next segment is called Sector Setups. That's the big picture. A lot of chop and a lot of noise. At the end of the day, you're getting really mixed signals in terms of the short-term environment. I always remind people to look at the big picture. And when I'm looking at a chart of the S&P, I'm finding a low in late September, now undercut with a new low in October. How excited do you want to be about stocks when the S&P is making a new low every month? And my answer would be not that excited, would be the way I would probably answer that question. That's where we're at so far, right? Because the low we got down to just below 3,500. Well, let's look at the sector story. I was talking with Julius de Kempener earlier today and chatting about a number of different things. And, when I'm looking at his RRG, his relative rotation graph, which he designed years ago, really shows you the dominance in energy when you're looking at this weekly time frame. So again, this is all based on relative strength So how these sectors are doing relative to the broader benchmark, and the S&P 500 is there at the crosshairs in the middle. And then you see things in general kind of rotating in a clockwise motion around that benchmark in the middle. So what is heading northeast? What is in the leading quadrant? What is showing you signs of optimism? Three sectors at this point, I think, would satisfy what I just said. Energy, number one by far. And again, if you look at the 11 sectors, which we'll hear in a moment, it's striking how different energy looks than everything else, right? It's so dramatically unique in that it's well off of a 52-week low, very close to making a new 52-week high. A lot of individual names, obviously, doing very, very well, appearing on the new highs list. Second's financials, which is noteworthy because we are now in the bulk of banks reporting earnings. Started at the end of last week. Today, let's see, I was looking at the list. Today we have Bank of America, Schwab, BNY before the open. Tomorrow we have Goldman, State Street. We've got Interactive Brokers tomorrow, Ally Bank on Wednesday. So there are a bunch of them through the course of BlackRock on Thursday. So quite a number to pay attention to. I think that'll be the story for banks in a lot of ways this week, along with obviously interest rates, which I would argue has been the story for equities in 2022 across the board. Healthcare is another interesting one, and look at how that is back into the leading quadrant this week, heading northeast, which is encouraging. And look how different consumer discretionary looks. You had a nice bounce today. The XLY was the number one sector out of the 11 today, but on the weekly time frame, on that longer term time frame, you're seeing a lot of movement away from consumer discretionary on a relative basis. What's really struggling on this relative look? Utilities in the weakening quadrant heading southwest. That's not great. Technology in the lagging quadrant heading southwest. That's also not great. Real estate by far the least attractive out of all of these on a relative basis using the weekly data. And again, REITs have been a tough place to be, and utilities as well, right? That big, meaty dividend component is fantastic when rates are so low that where else are you going to go for income? Might as well go to a high dividend paying, low volatility stock. But when the interest rate is, or when interest rates are much higher, and when you can get a decent payout from bonds or a savings account, how attractive do those dividends look? And the answer is not nearly as much. And I think that's certainly part of what you're seeing here. Higher rates don't tend to be great for utilities and REITs, and we're seeing that certainly being impacted there on the charts. Let's look at the 11 S&P sectors using the candle glance function. As a reminder, it's one of my favorite tools. If you have a chart list of anything, equities, ETFs, sectors, whatever it is, put them in a chart list and then use the candle glance function. And what you will immediately do, I always think of this as like a visual screening tool, right? Let me look at a bunch of these things all at once and just scan through them and see what looks different. I've often taken like the entire S&P or the S&P 100 or the Russell 2000, put all the charts up here like this, and then just start jotting down tickers. You can go through a ton of these. Just start going down through the list, make a note of anything that looks unique, that looks different, that looks particularly constructive, and then that's your watch list of a smaller list of names to try to look through. So what can you tell from looking at these 12 charts? There's the S&P in the lower right, and then the 11 S&P sectors. As I alluded to earlier, it's how different energy looks than everything else. We've talked about this before. I just want to highlight the XLE is testing its August high. So right, the S&P, the Nasdaq, swung higher into August. They all topped out at the 200-day moving average and rolled over. It looks a lot. I mean, the S&P chart looks a lot like the technology chart, of course, right? The low in June, the rally in mid-August to the 200-day, and then the failure there and moving lower. So while tech is nowhere near its 200-day moving average, same can be said for consumer discretionary or financials or any of these that are really more about testing their recent lows. If you look at the energy sector, it's actually back up to the August high. So while everything else has been sort of struggling and certainly chopping around in the last week, energy is kind of getting it done. That's why on a relative basis, it's done so well. This is why year-to-date performance, it's energy up like 50-some%, and everything else is kind of flats and much more negative than that. This is a really a key story here. And again, I had great conversations at ChartCon with people like Bruce Frazier and Greg Schnell in particular about the strength in energy and the potential, the reasons why these trades can continue to evolve. Mark Chaikin as well. We talked a lot about energy in our interview. Actually, I think it was when the cameras were off, but we certainly talked a lot about energy and the potential there. Some interesting charts for sure. What looks particularly not good or particularly weak, right? What is making a new low in October for the year? There are a number of sectors that are doing that. Consumer staples made a new 52-week low in October. Financials, same thing. Materials, industrials, technology, utilities, real estate, all of those sectors that I just mentioned, along with the S&P 500 itself, have made a new 52-week low in the month of October. Now, again, you've bounced a bit off of those lows, 100% understood. But let's take a step back and just look at the longer trend. These are sectors making lower highs and lower lows. I get excited when I see a sector not doing that, right? When you see a sector or a chart trying to make a new low and failing to do so, that's when you can get encouraged. That's why I think energy making a higher low in September was so important. What else has made a higher low? Only one other sector as I'm glancing through these. Maybe consumer discretionary, that's really more of a double bottom, but I think technically you could call that a higher low. That's worth noting. But healthcare is the other one I was going to mention. Take the low in June there, take the higher low around 120 on the XLV, and that's an encouraging chart, right? It's encouraging when a sector goes down to retest the lows and doesn't quite make it up there. It's encouraging when you see a bounce off of the lows and ideally getting above moving average resistance, which is what I think you're waiting for here. Especially interesting when you see the relative strength so strong. If you look at the last 2 months since the August peak, that's when the XLV peaked as well, but it's come off a lot less than the other sectors, which is why the relative strength has been so strong. In any environment, I would always encourage you to focus on stocks, ETFs, themes where the relative strength line is improving. That means whether or not the chart on the top is going up or down, you're doing better than a passive investment in vehicle. Doing that consistently is how you outperform just owning the SPYs or the Qs and start to generate some positive alpha, some positive outperformance. Let's take a quick commercial break. We'll be back with my next segment, Shifting Stocks. We'll see you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. A couple of quick announcements before we get to my next segment. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show, and we'd love to feature one of your questions live on the air on Tuesday's show. You can email us your questions, the Final Bar at StockCharts.com. We're on Twitter at Final Bar SCTV, and we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We'll gather all those questions. Hope to answer one of yours live on the air on Tuesday's show. Also, go to StockChartsTV.com. We have so much great content every trading day. It's been so much fun watching these markets along with some of my fellow StockCharts contributors. They have great words of wisdom and ideas and perspective to share with you every trading day for free. It's all at StockChartsTV.com or on your mobile device. Just search for StockCharts TV on demand. Let's continue on our show today with our next segment, Shifting Stocks. We talked about the big picture, talked about the sectors and how they're rotating. Now let's go through some of the individual names on the move, in the news, things you should be aware of. I want to start with the FANG stocks, or what I call the phenomena stocks. So I have this chart list, which I've tracked for quite some time. I added a couple names on here and turned the list of names into phenomena: Microsoft, Apple, Netflix, Amazon, Meta, Alphabet, NVIDIA, and Adobe. And I added those two technology stocks at the end because semiconductor is obviously a key group, and Adobe I thought just really spoke to the dominance of technology and making sure you're on top of the trends outside of some of the other FANG names that you might be following. So right off, look at the day today, right? The S&P was up. What did we say? About 2.7%. I think at the end, the worst performer, Adobe, was up just under 2%. Everything else outperformed the S&P today. Netflix up over 6.5%. Amazon about the same. NVIDIA, Meta both up over 5%. Those are big moves in some mega cap stocks. And the reality is, when those types of names of those market cap sizes are having big upswings, there's such a big weight in the benchmark that it's going to cause things to go up dramatically. Now, Netflix is an important one because they report earnings after the close tomorrow, if I remember right. Tesla's not on this list, but they report Wednesday after the close as well. Let's go through some of these charts here, and I just want to highlight a couple of them. And then, again, I think a chart like Netflix for a while probably has been the most attractive of the 8 charts that I mentioned there. And most attractive, the way that you get to that point, to be honest with you, is just not looking so bad, right? Microsoft making a new low, Meta making a new low. Those are not going to be my favorite charts out of any bucket. And then you have others like Apple, which overall have been in a bit of a downtrend, but not quite undercutting the June lows yet. Netflix is a bit of the opposite, right? It's almost a constructive chart pattern here, but it's been sort of stepwise, right? In April, you had that big gap down, and then we traded lower, hit an eventual bottom here in the 170s. From there, sort of range bound, then broke above there after making a double bottom in May and June. So a lot of things made a new low in June. Netflix actually did not do so. From there, we rallied, and now we've hit resistance around 250. We first hit that level in August, but we're now right back up there in September, October, a number of times. We're not to the 200-day moving average, so it's worth noting the S&P hit its 200-day, then kind of came all the way down, retesting new lows. Netflix pulled back a little bit, but only about 30 points or so. From there, it's been sort of range-bound. Now, with today's up move after the improvement Wednesday, Thursday, Friday last week, you're really close to making a new 3-month high, right? There have not been a lot of phenomena stocks on my new 3-month highs list, which I scan for every week. Pretty close to Netflix being able to do that. Now, we'll have to see what happens with earnings, but could be a very encouraging development, that for sure, and arguably the most attractive of those of this bucket of names. You know, Microsoft, when I look at the chart on Microsoft, I had a video on my YouTube channel last week, basically something along the lines of how goes Microsoft, so goes the world, or something like that. And it basically talking about mega cap technology names and the overweight impact they have, not just on the major benchmarks, but particularly like the XLK, where Microsoft and Apple together make up probably 40 to 50% of the XLK. Huge weighting, right? Which means however those stocks go, it's going to impact the overall market. Nice bounce off of the lows. You had this bullish outside day on Thursday, gave about half of back on Friday, but today getting above the open from Friday and getting above the range from the last couple of days. It's all encouraging. But what would you need to see to get really optimistic about a chart like Microsoft? I would say you need follow through, right? You need to get above a previous high, which means 250 would be the level to get above. As long as it remains below 250, this is still sort of a choppy sideways, maybe basing pattern at best. But at worst, we fizzle out at 250 and we continue this pattern of lower highs and lower lows. That's a Charles Dow downtrend, right? By his classic definition. Worth noting, by the way, on the chart of Microsoft, and I think Apple as well, but I want to highlight it here, a bullish momentum divergence, a low in late September, a lower low in mid-October, higher RSI, oversold the first time, not the second time. That's a bit of a red flag for the bears, right? Saying that you might be getting a momentum signal that the market's going to rally. Again, that's encouraging in the short term. For me, I'd love to see follow through. And that could be as simple as looking at a trend line from the highs, right? So if you take this, I'm just kind of quickly doing this. I'm not spending a ton of time to pay attention to it, but, draw a trend line like this. You might put it up here, one of these sort of tracking these highs. And the question is, can we get above there and stay there? We attempted to get above this trend line back here in early October, fizzled out. We're right at that same point again. And so, watching a break above trendline resistance is often the first indication that a trend is reversing. Then you want to make a new swing high, which means you get above 250, make a higher low. That would be, all of those things together would be sort of the classic rotation. So encouraging signs after we made a new low last week, but not enough to turn wildly optimistic in my opinion. Seeing a similar thing in Apple, right, where you have, although not as much of a divergence because weird day here, but if you look on a closing basis, you actually made a higher close there in mid-October. So a little different than the Microsoft chart. However, it's worth noting on Apple, we're not to a new low yet. We're sort of retesting the lows from May and June. If you think of May as the low, June was a retest of that low and then a rally. We're now right back to those same levels. So this is the area at which buyers have come in. This tells me two things about the broader market and certainly for Apple in particular. One of two things happens. Either buyers come in as they did in May and June. This is where valuations seem attractive. This is where people feel very comfortable owning Apple and taking on additional exposure. At that point, that's what causes the price to go higher. And that would be certainly the way that a seasonal rally between now and year end could certainly begin. Here's the other side of that coin. What happens if Apple undercuts 130, right? What does it tell you if the May low doesn't hold, if the June low doesn't hold, and if Apple undercuts there, makes a new low for 2022? For me, that tells you the S&P going dramatically lower. That says S&P 3200. The door is open for that kind of move. So these phenomena stocks are interesting to watch just for their own, the individual names, but also on a bigger picture to think about the overall rotation. We'll finish off with this chart. I don't know if we'll have time maybe for one other, but I do want to mention with Amazon, same thing, right, as you saw with Apple. Amazon, I would argue, with last week's sell-off and bouncing pattern, you got down around 105. That's right about where we bottomed out in the low 100s there in May and June. So we're kind of right in a rounding error of the lows, which means this could be setting up for a beautiful double bottom pattern and opportunity to buy. I wouldn't be, I mean, I get the argument for taking on a position and thinking of that as your downside risk and thinking of the upside potential. Again, as long as you have a stop in mind, I would say Amazon below 100 is a pretty ugly chart with the potential to go down to 80, right? Which is the low from March of 2020. I can't believe we're actually talking about those levels as not being too far off, but that's the truth. Tesla's another one. Again, I've sort of highlighted all of these names where we're testing those lows. This is what encourages me in some ways about the rally we may be seeing the beginning of. This choppy period is unusual, but if you see buyers really take control and see follow through to the upside, all of a sudden we're oversold at a previous support level. This could be a beautiful bottoming pattern for Tesla. But again, what concerns me is what happens when Tesla, if and when Tesla would break 200. All of a sudden, that big major support level from May and June not holding, that opens the door to much further downside for this market. That's what a real deterioration to S&P 3200 could look like. We need to wrap the show and go to the 3 and 3. Let's hit on 3 charts in 3 minutes that tell the story of this market environment. And here is chart number 1. Forget what the ticker is. This is a chart that had a nice rally off of a new low in January, December of last year, really made a higher low in March, another higher low in August. Now it's testing the high from June, pulled back a little bit. And I'm seeing a bearish momentum divergence with higher highs in price and lower peaks in the RSI as it's testing that resistance level. Is this a chart you would want to buy? And if the answer is yes, I would love to buy this chart, then that tells you probably want to be short the Nasdaq because this is the ultra pro short Qs. This is the triple short QQQ inverse ETF, right? Triple leveraged inverse ETF. If the idea that we're having a bearish momentum divergence leading up to resistance says, no, this is the most obvious sell in the history of sell signals, then maybe what that is your brain telling you that you probably should think more about the bull case for stocks because you're getting a big sell signal for a short ETF. One of the tricks we always used to use in my previous life was inverting the charts, right? Taking the ticker out and just inverting the price series to see what you would do. And it's sort of like, just disconnects your brain from what you know the chart of the S&P or the Nasdaq to look like. Might be an interesting idea to look at some of those short ETFs and see how excited you are about buying some of those charts. Might tell you something different about your broader market perspective. Chart number 2 is Bank of America. B of A reported before the open this morning. Nice rally today, right up over 6%. Can't deny that's a pretty decent bounce. This is after bouncing off of support just around 29.50. That lined up really well with the July low. So far, you're getting a really nice bounce on a key bank stock off of the lows there. 270 billion market cap on Bank of America, and obviously a pretty decent weight in the XLF. Here's the challenge, right? If you do get a further rally from here, we've got some overhead resistance around 37. That's the first Fibonacci resistance level, lines up really well with the August high and the May high, also right where the 200-day moving average is. So you got a little more upside, a couple more dollars, and then all of a sudden you're hitting a confluence of resistance. That concerns me a little bit about the upside possibilities for a chart like BAC. Finally, staying within the financial sector, some things go up, other things go down. Schwab reported before the open today as well. To the other side, what's interesting about this one, again, I haven't dug into the earnings call too much, but from my surface read of the call before the open today, pretty decent. It's one of the best quarters Schwab has probably ever had. Having said that, stock is down 2.25%. When a company has good earnings and the price goes down, that tells you something else is going on. And it could be a bunch of different factors that are all being reflected on this chart. But when good companies reporting earnings and they have a nice earnings win and the price goes down, that tells me, that's a little red flag in my head, tells me to question what's going on in this market. Resistance around 77.50, sort of like Bank of America flipped over, now selling off, making a new swing low below the 50-day moving average. Folks, that's a wrap for the show. Thank you so much for joining us every weekday after the close. All of our previous interviews and a lot of great discussions are at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.